Exercise 10.9 takes us through various stock transactions, and it tells us that at the beginning, this company had 100,000 shares of their common stock issued and outstanding. This is exercise 10.9 on page 491, and they tell us that there was 100,000 outstanding at the beginning of the year, and then on March 1st, they issued $65,000 additional shares of $1 par at $62 a share. So 62 times 65,000 is $4,030,000. Common stock, dollar par, 65,000 shares issued at $1 par. That's a credit to the common stock account of 65,000, and the balance, the 3,965,000, is additional paid-in capital. Here's where I need to draw your attention. On May 10th, they purchased back 6,000 shares at $65 per share. So 6,000 shares at $65 per share, that's $390,000 to purchase the treasury stock. So that's a debit to treasury stock and a credit to cash for $390,000. Here's where it gets tricky. Treasury shares do not participate in dividends. So we had 100,000 shares at the beginning of the year. We sold 65,000 additional shares. So that's 165,000. But we bought 6,000 back. So our balance is 159,000 shares outstanding, 159,000 shares issued and outstanding, issued and not bought back for treasury, 159,000 shares, and each one of those guys gets $2 per, for a total of $318,000. So that's a debit to dividends of $318,000 and a credit to dividends payable, $313,000, the immediate creation of a current liability upon the declaration of a dividend. Now, on July 1st, we're actually going to pay that. So on July 1st, we're going to debit our dividends payable and credit our cash. Remember, when we recognized the dividend, we created a dividend payable, and when we pay it, we liquidate the dividend payable. We've already handled the dividends. And then last but not least, we're going to sell some of those shares of treasury stock that we bought. That, how much did we buy them back for? We bought them for $65 a share. We're selling them back out to the market for $70 a share. So we're going to make $5 per share for each of those 3,000 shares. So that's $210,000 reduction or increase to cash, $210,000 debit to cash. Our treasury stock, remember, once a share is bought back into treasury, you ignore the par. You only focus on what you paid for it, and that was $65 a share. So 3,000 times $65 a share is $195,000. And our additional paid-in treasury stock is the difference, $15,000, or 5 times 3,000. Get the same number either way. The trick with that problem is you had to make sure that you reduce the number of shares that participated in the dividend by the number of shares that were held in Treasury.